All right, so today we'll be breaking down the FOMC meeting, obviously looking now at a pause as the Fed comes in with a flat, no change on interest rates. We'll get into breaking that down for you guys, what this might mean for the markets throughout the summer, but more importantly, what this might mean for crypto and digital assets as a whole. My name is Paul Barron. Welcome back into Tech Path. We'll be breaking this down for you guys today. Just as a reminder, we are dropping a super juicy video right after this that you do not want to miss. It is part of our wrap-up of the hearing that was done yesterday, and we had the likes of Circle, Jeremy Allaire, etc. on there, along with a very interesting character player that everybody needs to keep their eyes on. So don't miss that video. It is absolutely, I think, going to be a huge one to watch for you guys. So let's get into a little bit of this as everybody was looking and anticipating. If you look at the charts on the target rate probabilities for today, pretty much everybody hit it on the head. It was 96.6% for no rate change. That is exactly what occurred. Now, what does this mean? Some people look at this and say, well, Paul, this could be a pivot. It's a pivot toward an eventual reversal of interest rates. Or you could simply say, all right, this is a pause. If you think about what Chair Powell has said over the last few months, is his indication around pausing interest rates, his exact words were high interest, longer, for an extended period of time. Those are the things that I think we are facing right now in possibly pushing the markets. Now, if you look at what TED Talk Macro said, economists, of course, that were kind of looking at this, you saw almost everybody had pause in there, including Bank of America, Barclays. Citi was the only one that came in with a 25. Deutsche Bank, of course, and so on. Now, does this mean what we're going to see in the next few weeks, months, is possibly a reversal? Likelihood is not. If you think about the historical traits of how markets have responded to these kind of recoveries, the real question is whether or not this is going to be a soft landing. And when I mean that, going into a recession, possibly seeing a soft landing, maybe Powell has been lucky enough to orchestrate a potential soft landing here. I think a lot of people will still look at that and maybe or maybe not in terms of how he's going to pull it off. Here was Carl Quintella coming in on the whole Powell's tenure. S&P performance on the Fed days has been the worst of any chair with an average one-day gain of 0.13%. The bulk of the drop occurring in the final half hour during trading after he's been finished speaking. These are the kind of things that play out during, but if you can kind of see the historical aspect of this, Greenspan, of course, I think one of the better chairs, Bernanke, Yellen, and then, of course, Powell coming in right there. Not doing great there, Mr. Powell, in terms of your performance. The other thing that you got to look at is the history of this and what does this mean for the overall markets. And this is both traditional finance as well as the digital assets markets. Obviously, we know what's happening in the regulatory framework of what's going on with the SEC. If you're not following our hearing videos, those are probably I think some of the best information videos that are out there because we comb through hours and hours of hearings. We break down the best clips for you guys and shrink that all down into about 20 minutes. Plus you get analysis. So go back through our library. You can take a look at a lot of those that have been performing. But if you look at this tweet right here, data below right here kind of just gives you an example of when the Fed does pivot. I'll get this right today. Both all the way back to 2000. This is the one I want to take a look at. Fed pivots right there in 2000. You saw a pretty significant decline. This is during the dot bomb. Then you saw the 2007 pivot, which was obviously the last economic crisis we saw. And that was a 58% drop into the traditional markets. 2019, of course, the situation there, negative 35%. And then the question is right now in 2023, do we get a full pivot and when? That will be the big question mark. Now, we are going to be going into Powell's speech here in a few minutes. He'll be coming on in about 7 minutes. But what I want to get at here is this. When you look at the markets and how they've responded historically, and I'd love to get you guys' feedback on this, do you feel that we will see a softer percentage point for, if you go all the way back to 2000, and I don't want to go all the way back into the 1980s when we had some of the highest inflation ever, but if you look at 2000, probably one of the deepest, but then 2008, really the beginning of the end, I think, for the U.S. economy as a whole. And we saw a 58% correction there. Obviously, now we're at an all-time high when you look at the overall traditional markets. But I'd love to get your feedback. Do you feel like we're going to see a little bit less of a hit here in terms of traditional markets? Because remember, traditional markets often pair with what's happening in the digital platforms as well, especially around Bitcoin and Ethereum. The real question is now is, will altcoins have their day with all of the pressure that essentially other digital assets are getting upon them right now, delistings, et cetera, obviously the pressure from the SEC. So all of that playing out, that won't be necessarily addressed by Chair Powell today, I don't think, but I think it does have a lot of bearing on how digital assets will perform over the next 6 months. And that's the big question, because we will be heading into a Bitcoin halving next year. And this is a very critical 6 months between July and the end of the year, which is something we've talked about for quite some time. Toward that end of the year is the big point of when we could see a true pivot meaning that we're starting to see rate reversals, rates coming down, markets, of course, pricing in what we've already seen today. Another tweet here, U.S. core PPI inflation rises 2.8. Year over year, estimated was 2.9, so a little bit softer. Previous was 3.1. So slowest annual increase since February of 2021. This again also potentially portrays maybe a little quicker possibility of that soft landing and a potential reversal. The real question is going to be jobs, et cetera, as well as the extension of credit, consumer credit, how that plays out in the pricing markets for mostly retail here in the U.S. for consumption. And then also you've got real estate, commercial real estate being probably one of the biggest ones that we've got to keep an eye on as we take a look. If you think about that, because you could say, well, maybe the Fed has maybe went out too early on this, and did they? If you look at Canada, Canada actually did go out a little bit too early. So this was a problem right now where Canada said, okay, we're going to pause, and then actually saw a restart on inflation and then started again. That's the biggest question mark right now is, will the Fed continue its pause over the summer and we start to see a potential setup for that true pivot coming in? Remember, we talked to Darius Dale about this quite often, and he often brings out a very good point on this, is when the pivot occurs, that's usually when the market has its greatest cut. And if you go back to that chart I was just showing you, let me go back to that tweet. That's exactly the things that could be playing out here with 2023, especially in the investing community. And I also want to know from you guys, do you think Bitcoin has separated away, or are digital assets kind of pairing back in to the traditional markets with all the regulatory scenarios that are really facing us? So that's a big question, I think, overall. Another topic coming in right here. Yeah, I was getting a feedback there. Another topic right here, Eden Capital. This is, of course, the Fed moving historically fast to tame inflation. This again is, if you look at the chart right there in 2022, let me kind of zoom in on that for you guys. The fastest really ever in terms of rate hikes. As we all know, the acceleration up to 5% has been pretty significant. And it's also been a potential of flight of capital. That's another factor that will play out in this, because right now, most of you have probably seen all of your financial institutions, maybe some of your platforms out there, whether it's a Fidelity, Apple, Robinhood, et cetera, that are offering extremely high interest rates on your cash. That now, I think, will pause. In other words, we're not going to see any additional hikes on that cash. The question is when that will reverse and we'll start to see less interest. Now, when that does occur, that's when things in the market will get very dicey, and we could see a lot of things happening in traditional stocks starting to shift. And again, it goes back to that whole point of, will Bitcoin start to see a little bit of a reversal on that? I'm going to show you some sentiment data on this right now, because we pulled sentiment early this morning prior to the FOMC. Likelihood, I'm going to just take a peek over at Bitcoin right now. This is pre, and I'm on the daily right now. Let's go to the 15-minute, and we'll squeeze that out a little bit. So not tremendous drop off right here. We did get a little bit of a red candle, but the point being is that we could see Bitcoin start to go very unusual in terms of overall sentiment. Some people will look at this as a potential possibility for a summer reversal. When I say a reversal, maybe a possible climb for Bitcoin. Question mark will be, is the overall sentiment, how does that compare to things like amplification? So I know we got a couple minutes before Chair Powell is going to step on, and we'll get a chance to listen in to what he has to say. But I do want to hit a couple other tweets here. This, of course, was Rec Capital. Bitcoin has only reacted negative 19% since its mid-April local top. With all the negative catalysts in FUD, one would instinctively think that, of course, should have been much deeper. I would agree with that. I think the scenario that Bitcoin has not reacted to the amount of FUD that we've seen in the digital asset space, the economic front from a macro standpoint, gives me so much faith in where digital assets are going, especially around Bitcoin and Ethereum. And I still believe that we're in for a very interesting time here in the United States for whether we see scenarios playing out to regulating digital assets as securities and we get pathways. It also could create some very interesting conversations around some of these digital assets that are absolutely, there's no head of the snake. So you have a difficulty in being able to prove that out, in terms of a security. So I think those kind of discussions are going to continue to flow out through the summer months. And really the question will be whether or not we get an altcoin season. That's the difference here. So that could play out in Bitcoin over the next few months in a very interesting way, and whether or not you're investing in these. And of course, this is more of a global position. So I think that's a big factor also that comes in. Looks like he's getting ready to come on stage here. I won't unmute that just yet. The press corps is just kind of queuing up. Last tweet I'll hit on, of course, is CZ. Basically, he had a little tweet stream here, and he was kind of going into this whole issue of Binance has not sold Bitcoin or BNB. They still have a bag of FTT. Here comes Chair Powell. Let's unmute that and get you guys going in on what Mr. Jerome Powell has to say.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time. And I will have more to say about monetary policy after briefly reviewing economic developments. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. In our summary of economic projections, the median projection has real GDP growth at 1.0% this year and 1.1% next year, well below the median estimate of the longer run normal growth rate. The labor market remains very tight. Over the past 3 months, payroll job gains averaged a robust 283,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises to 4.1% at the end of this year and 4.5% at the end of next year. Inflation remains well above our longer-run 2% goal. Over the 12 months ending in April, total PCE prices rose 4.4%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In May, the 12-month change in the Consumer Price Index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025. Core PCE inflation, which excludes volatile food and energy prices, is projected to run higher than total inflation, and the median projection has been revised in the SEP up to 3.9% this year. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5 percentage points. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, especially housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. As I noted earlier, nearly all committee participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at this meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy.
All right, so key there, of course, is raising rates
determining the
toward
extent
end
of
the year.
additional policy firming that may be appropriate to return inflation to 2% over time. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In our SEP, participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 4.6% at the end of 2024, and 3.4% at the end of 2025. For the end of this year, the median projection is a 0.5 percentage point higher than in our March projections. I hasten to add, as always, that these projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do at the Fed is in service to our public mission. We will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Colby. Thank you.
Yeah,
Colby
so I
Smith
think-
with the Financial Times. I'm curious what gives
Let's listen to what
you and the
Colby
committee
had.
the confidence that waiting will not be counterproductive at a time when the monthly pace of core inflation is still so elevated. Interest rate sensitive sectors like housing, while they felt the drag of the past Fed actions, have started to recover in some regions, and financial conditions, most recently were easing.
So I guess I would go back to the beginning of this tightening cycle to address that. So as we started our rate hikes early last year, we said there were three issues that would need to be addressed kind of in sequence. And that of the speed of tightening, the level to which rates would need to go, and then the period of time over which we'd need to keep policy restrictive. So at the outset, going back 15 months, the key issue was how fast to move rates up, and we moved very quickly by historical standards. Then last December, after 4 consecutive 75 basis point hikes, we moderated to a pace of a 50 basis point hike, and then this year to 3 25 basis point hikes at sequential meetings. So it seemed to us to make obvious sense to moderate our rate hikes as we got closer to our destination. So the decision to consider not hiking at every meeting and ultimately to hold rates steady at this meeting, I would just say it's a continuation of that process. The main issue that we're focused on now is determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time. So the pace of the increases and the ultimate level of increases are separate variables. Given how far we have come, it may make sense for rates to move higher, but at a more moderate pace. I want to stress one more thing, and that is that the committee decision made today was only about this meeting. We didn't make any decision about going forward, including what would happen at the next meeting, including we did not decide or really discuss anything about going to an every other meeting kind of an approach or really any other approach. We really were focused on what to do at this meeting.
So there was no kind of initial debate about the possibility of July, any sense of the initial support at this stage for that move?
So again, we didn't make a decision about July. I mean, of course, it came up in the meeting from time to time, but really the focus was on what to do today. I would say about July, two things. One, decision hasn't been made. Two, I do expect that it will be a live meeting.
Thanks, Howard Schneider with Reuters. I was just wondering if you could help us understand the narrative here, because it feels like there's been a level shift in the dots, stronger GDP, less of a hit to unemployment, slower progress on inflation, and I'm wondering, in this sort of, where's the disinflation coming from?
Sure.
The labor market's going to be stronger, it looks like. It's not coming from there. Demand's not coming down all that fast, according to GDP. You've doubled your estimate of GDP. So what's the narrative here? It seems like it's getting more immaculate rather than more messy.
So you're right that the data came in, I would say, consistent with, but on the high side of expectations. So, and if you go back to the former SEP, the last SEP in March, you will see that growth moved up. These are not huge moves, but growth estimates moved up a bit. Unemployment estimates moved down a bit. Inflation estimates moved up a bit. And, all three of those kind of point in the same direction, which is, that perhaps more restraint will be necessary than we had thought at the last meeting. So, although the level, frankly, is pretty, the level of 5.6 is pretty consistent if you think about it, where the federal funds rate was trading before the bank incidents of early March. So But so we've kind of gone back to that. So your question is, where's the disinflation going to come from? And I don't think the story has really changed. The committee has consistently said and believed that the process of getting inflation down is going to be a gradual one. It's going to take some time. And I think you go back to the three-part framework for core PCE inflation, which is, we think, as good an indicator as you can have for where inflation is going forward. You start with goods. With goods, we need to see continued healing in supply side conditions. They've definitely improved a substantial amount, but if you talk to people in business, they will say it's not back to where it was. So that's one thing, and that should enable goods prices to continue, goods inflation to continue to come down over time. In terms of housing services inflation, that's another big piece, and you are seeing there that new rents, new leases are coming in at low levels, and it's really a matter of time as that goes through the pipeline. In fact, I think any forecast that people are making right now about inflation coming down this year will contain a big dose of this year and next year, will contain a good amount of disinflation from that source, and that's, again, probably going to come slower than we would expect. That leaves, the big sector, which is a little more than half, pardon me, of core PCE inflation. That's non-housing services, and we see only the earliest signs of disinflation there. It's a very broad and diverse sector. I would say in a number of the parts of that sector, the largest cost would be wage costs. It's the service sector, so it's heavily labor intensive, and I think many analysts would say that the key to getting inflation down there is to have a continuing loosening in labor market conditions, which we have seen. We have actually seen, I go through a number of indicators suggesting there's been some loosening in labor market conditions. We need to see that continue. I would almost say that the conditions that we need to see in place to get inflation down are coming into place, and that would be growth meaningfully below trend. It would be a labor market that's loosening. It would be goods pipelines getting healthier and healthier and that kind of thing. The things are in place that we need to see, but the process of that actually working on inflation is going to take some time.
Nick.
Yeah, one of the things I want to hit on there. Let's clip them off real quick, just so we can get this point. There's a big point here that they're making around whether or not they can get back down to a true 2%. I think that's the thing that Chair Powell is really going to be facing as the problem. And this is also going to, I think, have a huge bearing on how we'll see asset prices start to recover.
This year. So why not just rip off the Band-Aid and raise rates today?
So first I would say that the question of speed is a separate question from the question from that of level. Okay, so and I think if you look at the SEP, that is our estimate, our individual. It's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting. It's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly. And there are benefits to that. So that gives us more information to make decisions. We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward. And we'll get to see, we don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and this is if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip, the decision makes sense.
I know you said July is live with only one June employment, with only the June employment and the CPI report for June due to be released before the July meeting. You get the ECI after, you get the senior loan officer survey after, you get some bank earnings at the end of next month. What incremental information will the committee be using to inform their judgment on whether this is in fact a skip or a longer pause?
Well, I think you're adding that to the data that we've seen since the last meeting too. Since we chose to maintain rates at this meeting, it'll really be a 3-month period of data that we can look at. And I think that's a full quarter, and I think you can draw more conclusions from that than you come from any 6-week period. We'll look at those things. We'll also look at the evolving risk picture. We'll look at what's happening in the financial sector. We'll look at all the data, the evolving outlook, and we'll make a decision.
Gina.
Thanks for taking our questions. Gina Smilek, New York Times. You obviously, in your forecast, marked up the sort of path for growth, marked down the path for unemployment, marked up the path for inflation pretty notably. I wonder, since March, what has changed to make you think that the economy is a lot more resilient and inflation is going to be a lot more stubborn? And given that, why do you feel confident that this is as high as you're going to have to revise the federal funds rate, or do you think it's possible we could have even a higher than 5.6% terminal by the end of this cycle?
I mean, on the first part, I just think we're following the data and also the outlook. The economy the labor market, I think, has surprised many, if not all, analysts over the last couple of years with its extraordinary resilience, really. It's just remarkable, and that's really, if you think about it, that's what's driving. It's job creation, it's wages moving up, it's supporting spending, which in turn is supporting hiring, and it's really the engine, it seems, that is driving the economy. So it's really the data. In terms of we always write down at these meetings what we think the appropriate terminal rate will be at the end of this year. That's how we do it. It's based on our own individual assessments of what the most likely path of the economy is. It can actually in reality wind up being lower or higher. And there's really no way to know, but it's what people think as of today, and as the data come in, it can move around during the intermeeting period. It could wind up back in the same place, but it really will be data driven. I can't tell you that I ever have a lot of confidence that we can see where the federal funds rate will be that far in advance.
Mr. Chairman, thanks for taking my question. You had said back at the end of May that you thought risks were getting closer to being into balance. Is that still the case, or has your mind changed about the balance of risks out there? And also, could you give us an idea of what would be a sufficiently restricted?
All right, so we're gonna cut there. Looks like pretty much everything is coming in as expected. The key things here, I think, for a takeaway on this is going to be whether or not the Fed can get us back down to the 2%. This is going to be a sticky number, and you'll remember his statement about getting another quarter point towards the end of the year is a real possibility. So, big characterizations around Powell's statements. At the same time, he's saying that we are seeing some softening business and jobs, both with consumer credit also playing into this, real estate playing into this. I think we're in still for a very tumultuous summer that will open up an opportunity for us to either continue the flat scenario where we see no more rates possibly in July, which is going to be the live meeting. But again, back to the other question that one of the reporters asked is what kind of new data is coming in? And not really, but he's looking at more of a quarterly, which would be a little bit, at least more of a data chunk to look at. But overall, still a very interesting time right now. If you look at sentiment right now on Bitcoin, I'll just jump over to the Bitcoin chart, because we've been going up and down a little bit here, but it has been somewhat downtrending back down here. We saw a little bit of lift right here on amplification here just in the last day. So we could see maybe a little bit of action here on Bitcoin. It looks like the chart is still responding slightly. But again, this is on the 5 minutes, so we'll see how things paint out on this. Again, we'd love to get your input. And of course, if you like these guys, make sure and smash the like button, because that's a big key on whether we do these kind of videos in the future. Do you like them? If you do, hit that like button. It does help out. Let's go to the poll real quick, see what you guys think about all this. All right, 24 hours after the Fed. Looks like everybody's on the middle right there, pumping 37%, remaining the same at 37%, and dumping at 26%. So very split audience results today based on the data that has come in from the Fed. Now we're going to have a whole lineup of additional videos for you. We'll also most likely get some macro analysts in on this mainly because we need to take a look at how the Fed is going to get to a 2%, because that's the real question. Many people still think we're probably going to hit more in the 3% mark, which could extend this out and possibly see a recession that is a soft recession, but maybe for a longer period of time. That, in my opinion, would be one of the worst things that could happen. So we will be doing those. We're going to be premiering a video also coming up that you guys do not want to miss. We've got Meta Lawman coming on. We're going to be talking about the current legal state against Gary Gensler, what that might look like, and then our hearing video, which is an absolute barn burner. Don't miss that one. It's a special one. You guys do not want to miss it. Also, if you guys are not in the Diamond Circle, make sure and get in now. It's another place you can get our own private. We do another podcast over there on Web3, but I also drop in a lot of these audio casts, which is additional analysis. We also do breakdowns of our own sentiment data over within the Diamond Circle, so you guys can catch a lot of that stuff over there. Of course, if you want to catch me, it's out there on Twitter, @Paul Barron. We'll catch you next time right here on TechPath.